My unconventional financial advice is that many young people should invest less and spend more because when you're young, memories compound faster than dollars. You have the rest of your life to make money. You have only a few years to be young. This is from your book, Jack. I think it's great analysis and a sage guidance for a young person. Tell me what you mean by this.
So there's a lot of talk, especially in Silicon Valley, about the permanent underclass these days. I actually think you should enjoy it while you're there. I think the underclass can be a lot of fun. So that's half in jest, but yeah, I think a lot of particularly young people are super, super, super stressed about not having enough money or status yet. And I take the flip side of that, where there's actually a lot of fun stuff you can do and a lot of fun opportunities you have when you're what I would call like pre-rich and pre-status, where you're living with your roommates, you're not making that much money yet. You can have basically unlimited fun for $100 in New York or San Francisco or LA or whatever. It's actually very okay to spend money on the fun things when you're young, and you shouldn't feel bad about that. Is kind of my take. There's a whole subset of fun life experiences that 25-year-old you can have that you can't have later. So you shouldn't feel ashamed for actually wanting to lean into that.
Well, one of the interesting things that you point out is that maybe $5,000 when you're 25 is actually more useful than even $50,000 when you're 50, which I think is really interesting and also pretty counterintuitive too, because if I think about today, wow, I'd love an extra 50K sitting around, but really, if I'm young, I don't really need it.
So I think I'm almost positive Nikita Beer, former head of product at Twitter, or formerly known as Twitter, X, the everything app. A couple of years ago, he tweeted, he was commenting to somebody else, and I think it was a little bit sarcastic, but he basically said, every year of your 20s, you should value at $10 million, basically meaning you shouldn't sell your time in that period for anything less than that. I think 10 million is a little bit high, but I think the direction of you should really value your time as a premium when you're young, because you have max optionality. You're healthy, you don't have many responsibilities, and you can basically do anything. So putting yourself in life circumstances that remove that optionality for any number less than a really big number probably doesn't make sense. So yeah, I mean, my whole life philosophy, and frankly book philosophy, is like, you can have a lot more life enjoyment or utility for a smaller amount of money when you're young. And the amount of money it takes to get that same level of enjoyment only goes up as you get older. So it's okay to spend that marginal amount of money on cheap thrills, because you're probably going to be glad you did 30 years later.
Well, I think part of it too, the idea that you should put as much percentage of your paycheck into a retirement account as possible. That's very classic investing advice. It's like the younger you are, the more you should invest, because it's going to compound more by the time you retire. That's true. And I think that makes total sense. But at the same time, $1,000 put away per month or every quarter, you could probably make more utility of it as a young person just to spend it on, frankly, random shit.
So, well, all of that is true, but also I think over fixating on, again, this is gonna sound, I was on Scott Galloway's show a couple of weeks ago, and I'd made a comment about this where people in the comments section basically saying I was an out of touch asshole. But I actually think there's way too much focus from like personal finance gurus on, optimizing your downside, like how much should you contribute to retirement, all this stuff. Like, yes, you should contribute to retirement, and you should take, if your company has a 401k match, you're leaving free money on the table by not at least contributing enough to get that. Like, I am all in on that, but I actually think the solution to most personal finance problems is figuring out how to make more money and then doing that, whether it's aligning yourself on a career path, whether it's, especially when you're young, you have a lot of free time. So, my take is not go full hedonism and just get drunk all the time and blow all your cash. You shouldn't feel bad about spending money, but you have a lot of excess free time where you can work on side things that generate money too. And I think about it like this, like there's a certain amount of like spending money where you get more and more enjoyment and then it flattens off, but you can keep making more money well past that point where you shouldn't cut off your, like, let's say spending $50,000 a year gives you this much enjoyment, spending $100,000 gives you this much, and $200,000 gives you this much, where like it starts declining. If you're making $50,000, you get $50,000 enjoyment, they net out. But if you can get your income up to 100, 200, 300K, you can maintain your peak level of life enjoyment while increasing your savings rate by increasing income. So my actual like financial advice is both don't cut out things that you want to do when you're 25 because you're worried about not saving enough. But if you are worried about that, there's actually only so many costs you can cut. Like at some point you have to pay rent, you have to pay for food, and you should spend money on some things that you find enjoyable, desirable. So the math gets much easier if you can increase income than it does if you can keep cutting costs. And it sounds a little bit woo-woo, but there is I think there's a lot of truth to just your mindset on being an optimist versus a pessimist, and over focusing on the downside is inherently pessimistic because you're preparing for the worst. Having an optimistic mindset that things will work out and I can make things work out, I think can, help you make more money.
I think it unlocks everything. If you believe that anything is possible, you have a better shot of fulfilling that belief that anything is possible. So we're in this very weird moment where young people especially complain that they can't afford anything.
Yep.
And we talk about the permanent underclass. Everyone's worried that they're not going to make it because of AI, whatever it is. But then at the same time, you do see this huge boom in financial risk-taking.
Yep.
So these things go hand in hand. And we have this crazy chart from Bloomberg that shows Gen Z is increasingly moving money from stocks to sports betting. And this is actually part of a long-term financial strategy for a lot of young people.
Yep.
What do you make of this?
So it's a two-part question. On the first part, that young people feel like they can't afford anything, I think that the real issue is not lack of, there is, as far as housing costs going up, I think that is a singular issue that's a problem beyond cars, food, expenses going out, whatever. Like rent in Manhattan is really, really expensive. Rent in San Francisco is really, really expensive, especially compared to pre-COVID. Even when you adjust for inflation, if you're paying $4,500 for a studio in Manhattan, that's pretty crazy for like a 400, 500 square foot apartment. But there's also this whole, particularly in high cost of living cities, you have this mix of people who are covering their entire lifestyle on the money they're making. And then there's this whole long tail of like parent subsidized lifestyles, and everybody's operating. I'm sure you have had and have friends who like mid to late 20s have a kick-ass apartment, but they don't work for a hedge fund or haven't sold a company. It's like, how are you affording this? And there's probably some family help, which I don't shame at all. I think, if you're in a spot where your family can help afford you to live in New York and have a higher standard of living, sick. Like especially if somebody's in their first job, they aren't making much money yet, you can put them in a better apartment. Cool. But if you're the person who is trying to figure out how to budget your own lifestyle and you feel like you're behind because your friends have way nicer apartments, despite you having a good job, it's really worth keeping in mind that not everybody's financial situation, especially family financial situation, is the same, or some people are going into credit card debt to maintain that level of lifestyle. And I think having a clearer view or a clearer perception of not everybody's coming from the same situation and playing the comparison game against people who don't have the same life setup as you is really, really dangerous. I think that's what starts causing this anxiety of, I feel like I'm falling behind despite doing everything right. One, the internet isn't real life and you're only seeing the top 1%. And like the average person is just probably not living at all like what you think they are, because that's not what you're seeing online. And two, a lot of people you are around might have different like financial backstops than you do, which is fine, but you shouldn't feel like you're falling behind. But getting into the sports gambling thing, yeah, you start feeling these pressures of, I'm 26 or 25 and I feel like I haven't earned enough money yet and I should be more successful and I should have hundreds of thousands of dollars, millions of dollars saved up. And then you start seeing the big hits of somebody made, like every football season, somebody does a 12-leg parlay where they pick the game 3 Josh Allen over under passing yards, and then they pick the color of the Gatorade in the Super Bowl. They turn $7 into $4 million or whatever. So you think, okay, well, that guy was an idiot and he did that, so I can probably do that too. And it was DraftKings and FanDuel, and now we have prediction markets, which is great because we made an asset class that's sports betting, except it doesn't call itself sports betting, but most of the volume on those prediction markets is, sports betting. And yeah, some people are going to win. It's a small minority, but like there will be some people who make millions of dollars off of this. And there are going to be a small subset of people who do have some edge in some weird niche market where they make a lot of money. But the both median and average user is going to lose money. And there's the opportunity cost of that money is that money could have, yes, you could have put that money in stocks, which is a better investment. You also could have just spent it on fun stuff. Like if you blow $10,000 on Polymarket or Kalshi or DraftKings or whatever, and you could have gone on like 2 ski trips with your friends, that's stupid because you did not make money from that. You got no life fulfillment utility from that. You just gambled and lost. And this cycle, like I remember during COVID, it was people trading meme stocks. A lot of people made money on GameStop. A lot more people lost money. It's the exact same user behavior. It's shifted from GameStop and AMC and Virgin Galactic and Tesla to the Golden State Warriors and LA Lakers and which song is going to win whatever award on the award show. But it's dangerous because you just keep setting yourself further and further back. And it's a negative loop where if you lose $10,000, you get in your head that, oh, now I need to earn that back. So you make a more aggressive bet. Like the more money you lose, the further out on the risk curve you go until you really blow something up that you can't get back.
We talk about the AI race all the time on this show, and everyone has a different take on whether OpenAI, Anthropic, Google, Meta, or even SpaceX AI is in the lead. Whatever your favorite AI lab is, there is a way to invest in it through Harbor Capital Advisors' AI Labs Ecosystem ETF suite. These ETFs allow you to invest in the ecosystem behind the AI lab you believe in most. Search Harbor AI Labs ETFs wherever you invest, or follow Harbor Capital on X to learn more. Visit harborcapital.com for a prospectus containing investment objectives, risks, fees, expenses, and other important information. Read and consider it carefully before investing. Risks include principal loss and artificial intelligence-related risks. Harbor ETFs are distributed by Foreside Fund Services, LLC. Harbor is not affiliated with Full Signal, and the funds are not affiliated with, sponsored by, or endorsed by any AI lab. And I think the bad thing about something like prediction markets, they pretty much have a infinite runway right now, at least by the looks of it, by the amount of money they're raising, the rise in popularity.
Yep.
It's not like a very limited time frame with something like GameStop. It was kind of like a flash in the pan.
Yep.
AMC, flash in the pan. But prediction markets, these things are being used as economic indicators now too. It's like people are determining what the Fed will do based on what they see on prediction markets,
Yep.
which is insane. But that gives it sort of a economic utility that will give it a very probably indefinite runway. And we have this other chart here. More than 80% of Polymarket accounts lose money, and only 2% of accounts have made more than $1,000. And my sense is that of that very tiny fraction that's actually made money, a bunch of that's probably insider trading.
Totally.
So that, you know, there's all these issues.
It's insider trading and then like market makers and professionals who are just, they are going to do way better than like the collective hive mind of retail.
Yeah, it's not a great bet to make if you're trying to compete, you know, from your mom's basement against hedge funds that have algorithms predicting your every move, essentially. Okay, so tell me about this idea of stage specificity of life, especially in the context of being young, not having a lot of money, and trying to determine whether you should be investing or not.
Yeah. So again, my high-level financial advice is don't over focus on the downside because you'll just make yourself anxious and spiral, and it's kind of a self-defeating mindset. And the best way to increase your savings rate is to put yourself on a career path where you'll make more money over time. Now, assuming that you agree with that and you are intentionally chasing what I would call like a high slope career path, which could be anything. It could be, you know, there's working in finance, tech, consulting, entrepreneurship, whatever. I do think that for my advice to make sense, you have to agree with me that like going after a career path that increases income is good. And that's what unlocks the rest of the equation. But on the stage specificity of life, you know, like we are 29. 29-year-old Phil is not the same person as 24-year-old Phil, and he won't be the same person as 35-year-old Phil. 24-year-old Phil was not married. 29-year-old Phil is married. 35-year-old Phil might have a kid, right? Like there's different versions of you that all of a sudden has different responsibilities. You have different desires, different priorities. Your social group is totally different. There's a difference between living in New York at 24 with 3 roommates and a 2-bed apartment. But guess what? You put the fake wall in the middle and you make it work and everybody has a twin or full bed. You're having a blast. And living with your wife and then having a kid, right? Where both the amount of money it takes to maintain the lifestyle that you want and the things that you want in that lifestyle are just totally different. So as a general rule, the younger you are, the more that you're probably going to enjoy the cheap thrills, whether it's you live in New York and it's going out with your buddies and like blowing it out on a Friday night at some dive bar, Murray Hill, or like when I was 24, I decided you and I have a similar experience where we both spent some time abroad. You were in Hong Kong, right?
Yep.
And I was backpacking around Europe and Latin America. But I think we would both agree that we had a certain type of lifestyle in our early 20s that you probably couldn't replicate now, and you also probably wouldn't want to, but would consider it a formative experience that you did it at that point. That's what the stage specificity of life is. There's certain experiences that have an expiration date when you wouldn't get max enjoyment out of them. And the time to go after some of those experiences is probably going to be sooner than you feel financially comfortable to do so. But that doesn't mean that you shouldn't do it.
When I was graduating college, I was very comfortable staying in hostels in Asia, backpacking around, carrying essentially nothing with me. It was a blast, met a lot of great people. But today at 29, I would be much less likely to enjoy that. Like, I wouldn't want to rent a mattress on a floor for $20 a night.
Right.
Probably. Maybe in certain scenarios, but most likely not. My wife certainly would never do it
Correct.
with me. So that stage specificity, I think it's obvious when you say it out loud, but until you see it written out, it's actually not as obvious as you would think, because most people think, oh, I'll just go stay in hostels and go backpacking once I set my career, once I make enough money. But that's not really the case.
And it's also like, that's not a thing that everybody wants to do. It's a thing that we wanted to do. And the broader takeaway is, I do think everybody has something that college them or fresh out of school them wanted to do, and they've kind of just kept pushing it off. The cost to do that thing is probably lower than you think, and the consequences of doing it when you're young are much lower than you think. The consequences of blowing your life up at 24 and going somewhere weird aren't that high, because a year later you can always redirect. At 34, they could be much more catastrophic, where the money you're leaving on the table or the position you put your family in is just much worse. And you know what I mean? So there's just this whole subset of like young person thrills that younger you should go after. I mean, I think like Bill Perkins in his book Die With Zero, like Bill Perkins has been incredibly successful. He runs his own hedge fund. He started a few companies. He's produced movies, and he's a pro poker player. Talking about people who have won life, I would put him probably top 5 or 10 most interesting people alive right now, who I think have very cool paths. But in the first chapter of his book, he discusses in his first job, he was working on Wall Street, not making much money. His best friend took a payday loan and went to Greece for like 3 months, and then came back. And he's now been like a very successful energy trader. And Bill did not do that and didn't really travel abroad much until he was 30. And his takeaway in hindsight was that he should have taken the trip too, because it actually just would not have impacted his career that much. And by the time he had the money, he was comfortable doing it. That specific type of trip was gone. So I don't know, like I've talked to enough older people that wish they would have done more weird, interesting stuff when they were young, when it was easier to do that with their lives, and they didn't, that it sort of reinforces my belief that I made the right decision doing that.
I feel the same way. And when I was a senior in college, I was in San Diego, and I had a kinesiology degree coming out of school. I was determining between going to grad school, which I got accepted to, or moving to Hong Kong and seeing what happens. Every single professor I asked who were teaching in the grad program, when I said, should I do your program or should I travel? They all said to travel. And they were, they were incentivized in theory to tell me enroll in their courses. So I think most older people realize it, but then by the time they realize it, they're old.
What's the phrase? Youth is wasted on the young. It's which everybody's grandparent has told them when they were 12. And I'm like, what are you talking about? I don't know what any of this means. Anyway, it's nice to be rare people who did recognize the fragility of youth and actually did something with it.
Tried to. Okay, Jack, let me ask you about this. A lot of young people do not have confidence in the traditional wealth building channels. Even as you say, hey, set yourself up to make higher salaries as you go into your career. That doesn't feel fast enough to a lot of young people. Something like having a job, buying index funds, that is not the path that a lot of people believe will lead to financial freedom or wealth. What do you think?
I still think it's the right move. I think we have had how again, I actually think the most of this whole like just broader feeling of anxiety and like I'm never going to get there in life is downstream of housing costs are way too high. I think if housing cost if the ability to buy a home was easier and rent prices were lower, I don't think you have any of these problems because that's actually the one big purchase that at least in America we have defined as this is one of the final milestones into adulthood. It's like buying a home, getting married, having kids, right? And inability to buy a home also like there's this, there's a lot of talk about declining fertility rates, blah, blah, blah. I think that because marriage and home ownership are so uniquely intertwined, I don't know which one I would say is like the leading cause of the other one, but I do think there's a relation between delayed marriage and family formation and an ability to afford a home. Like, yeah, it's, if you look at prices in Manhattan, the ability to buy a 3-bedroom apartment in like an Upper West Side or whatever is going to cost millions of dollars, which this is the prime real estate in America. That's somewhat understandable that happens, but people are feeling this everywhere. Right. And it's because older generations will never want to vote in legislation. Like there's no way to increase supply without prices coming down. It's supply demand is like the most basic concept in economics. If you have more of a thing, the price of any individual thing drops. Older people tend to vote more, to go out more. If there's like videos that go viral on Twitter all the time of like local San Francisco Bay Area town halls and city council meetings, and the median age of somebody attending that is probably 65 or 70. People who have owned their home in the marina and they bought it for $400,000, it's worth $4 million, do not want like multifamily facilities getting built there. So I actually think that like one thing that would help a lot is younger people actually getting more involved in local politics and pushing for policies that benefit them to build more housing. If you want affordable homes, you need more units. All that being said, I still think the getting in a career that seems to like high leverage career, high slope income, and then putting money back still works, but you might not be able to buy a home as early as somebody did in the past. Like home ownership at 28 or 29 is a lot harder now. You can still get there in your late 30s if you stay the course. But it's tough because, everybody's comparing themselves to the tech entrepreneur who sold their company at 28 or the person who joined the upstart fund that did really well, right? Like the hardest thing is like I'm friends with, which they've had a crazy year, but Situational Awareness, the hedge fund. I have a buddy who works there and they had a really good first year, right? Like I have no idea how much money anybody made there. You join an upstart fund, they have a good year, you make good money, and it's like, wow, like this is really cool. And it's also really easy to compare yourself to that outcome. But that's like one example out of thousands of people I know. I think people overfixate on the outlier winners within their social circle, and that's a really big source of anxiety.
I think especially if you live in a city like New York, New York or San Francisco, you're going to be in this very densely populated place of outlier individuals that make a bunch of money when they're really young.
Yep.
So then it feels like you're so tremendously behind. A lot of the pushback I hear from older investors and adults, if you say as a young person, hey, I can't afford a home, or I don't have enough money to put into my retirement account this month, they will often push back and say, look, you're over-indexing to the doomer headlines and you're not looking at like the bigger picture. And when I was your age, I could do whatever. They're talking about a entirely different economy, entirely different market, and even entirely different job market. All these things I think are uniquely issues of 20-somethings today, but you can only feel it if you're in our generation, I think. So it's so easily dismissed by older policymakers or older investors, but that's really hard to communicate.
I just think the world for young people today feels way more hyper competitive than it did because we're way more interconnected. Like I had a reference in my book about how the suicide rate in Palo Alto high schools is much higher than the national average. And it's such a hyper competitive, everybody's parents are tech execs, like high power attorneys in the Silicon Valley area, wealthy VCs. And you have all these, everybody's parents are winners, and then their kids are surrounded by the, kids of other winners. And it's just super cutthroat for everybody's competing to get into Harvard and Stanford. So, you're trying to be a top level athlete, but you also need to be able to do the math Olympiad, and you should probably play an instrument, all this stuff. And there's just a bunch of horror stories from the 2000s and 2010s about like suicide rates, people jumping in front of trains, whatever. And the amount of anecdotes that like the Atlantic had a really good piece on this where they quote a couple of students, how they just feel like they're drowning in status pressure. And that was localized because obviously the internet was around them, but the internet wasn't quite as ubiquitous and social media wasn't quite as all-encompassing as it has been, say, post-COVID, where you used to have these localized status games where Palo Alto kids compare themselves to Palo Alto kids. Now, kids from Tifton, Georgia, where I grew up, can also see Palo Alto kids and think, man, those are the winners. I should be doing that. Where everybody with a high level of self-awareness that is somewhat plugged in online can see these outlier outcomes, and they know that they themselves aren't there yet. And it's like really exhausting trying to keep up with that. So I agree with the older generation that people probably over-index on doomer headlines, but the thing the older generation didn't have to compete with is, if you were from wherever in the country, and then you went to Yale undergrad, and then you went to Wall Street, you were just kind of only aware of the people in your bubble of your hometown, then your college, then who you're working with, where even if you're in a really competitive game, you're isolated from the rest of the world. You might hear snippets here and there, but you weren't constantly seeing this bombardment of excesses and success. And I think the toughest thing is actually, how do you drown out the noise of social media and just focus on doing your thing and working on things that compound? And it's just really, really hard to block out the noise when there's so much easily accessible noise. That's why the whole sports betting, prediction markets, gambling on stocks is a thing. People are trying to skip a lot of steps and just get to that top level. And there's a very, very, very real like philosophy among a lot of young people where if you feel like you're in the permanent underclass or you're kind of at the bottom right now, blowing up and losing a few $1,000s you're already at ground zero or rock bottom, but that like 1% of 1% chance of making $1 million is worth it. And you'll just do the stock market lottery ticket over and over again until it hits, because if one of those things hits, all the other losses don't matter. That's a legitimate like philosophy some people have with personal finance. And I see how they get there. They're trying to skip a lot of steps.
Also, it's so much more alluring to do that when you're scrolling social media and you see people your age going to, Ibiza for a vacation, or they're going to all these foreign countries.
Also, Ibiza is so overrated. That's a whole other topic. The place sucks. I've been 3 times. I went when I was 21, had a blast. I went when I was 26 in the Gap in business school in that summer, and it was still fun, but I felt like I really don't need to do this again. I actually went twice. I was going to go a 3rd time and bailed on the trip because I had to finish writing that. Ibiza is so overrated. Like Ray Dalio at Ibiza at 77. Come on, man. Like you can't be having fun there. The place is trash.
I mean, I imagine let's say the ROI on going to Ibiza goes down tremendously after like 22. Probably.
Yeah.
Something like that. Tell me about what you were doing trading SPACs during the pandemic.
So my most proud thing is that I'm probably one of maybe 5 people who actually made money on SPACs, not named Chamath. Thank you, Chamath, for creating a bubble that, the poly market chart of only like 2 people have made $1,000, whatever. Yeah, that was me in the SPAC game. So very proud of this. I can speak to financial market degeneracy because I myself have been an active player in one of such bubbles, and the user behavior is always the exact same thing. I was, at least for about 9 months, in that little bubble of people who did have some form of information edge, and I exploited it until it didn't work anymore. Basically, COVID hits. I just started my first job. I thought the market was going to go to zero. I had $10,000 in a brokerage account. I bought $10,000 in SPY puts. I made $20,000. I thought I was a genius. I then bought $30,000 in SPY puts when Bill Ackman was crying on TV. And that was the day the market bottomed and it started going back up. And I round tripped 10K to 30K to 10K, scared the shit out of me. And I put $6,000 in a Roth IRA. I put it in the QQQ and I said, I'm never going to touch this again. Just make your Roth contributions and work. 2 weeks later, my best friend texted me and said, hey, do you know what a SPAC is? And I said, no. And he said, well, DraftKings is going public through a SPAC. So if you buy this thing, you will then own DraftKings stock whenever this merger happens. I said, okay. And then I look at the SPAC and start digging into it. I was like, okay, this is like an alternative IPO. And I noticed that most SPACs also had warrants. SPACs price their deals at $10 a share. Warrants give you the right to buy the stock at $11.50 a share. They're basically a call option. But my issue when I was gambling with calls and puts on the S&P was that they typically expired in a month, and time works against you and you get hosed. Warrants don't expire for 5 years. So two things that were really interesting were, one, if you buy SPAC's shares before a merger happens, you can redeem them for cash the day before the merger closes. So you have a floor at $10 a share. And the warrants, if the stock really starts to rip, give you a ton of leverage on the reflexivity if it starts going up. Where if the SPAC is $10, the warrant might be 50 cents or a dollar. If the SPAC goes to 20, the warrant's going to be worth $9. So I was like, can I front run? Like, can I beat the market to SPACs that get hot? And I kind of developed this hypothesis that anything related to electric vehicles, marijuana, sports betting, or outer space, if the valuation of the deal wasn't absolutely crazy, would probably rip as a SPAC. And I had a web scraper that would pull like all of the SEC filings when a new SPAC merger was announced. My burner Reddit account, Barmelo's Anthony, play on words for Carmelo Anthony and Xanax bars, was my group me name from high school. I started the SPAC subreddit, so I would get like first look at all the SPAC information. And long story short, I was just parlaying warrants. I would just YOLO SPAC warrants, make money. And the catalysts were crazy. Like I remember that Apollo had a SPAC. I saw that they had changed their website background from oil rigs to windmills, and I figured they were going to take an EV company public. That was the thesis. Website changed. They added somebody on their board with like EV battery experience, and I YOLO'd the warrants at 70 cents. They announced a deal with Fisker Automotive. Warrants jumped 400%. I cash out. I just did that over and over again and turned $6,000 into $400,000, and that was pretty sick. I was 23. What ultimately ended up happening was the SPAC bubble there were too many SPACs. It got diluted. It stopped working. And then I just tried to swing trade microcap stocks to $1 million. And that's where I got blown up. To this day, I will say I had one of the best SPAC trading strategies out there. My only regret is not being a little bit older and being in New York, where I could have joined one of the SPAC ARB funds for a couple of years back then. But I got so addicted to watching number go up that when I had a legit strategy, it worked. And then there was thesis drift, where when my thing stopped working, I thought I could just immediately start making other trades where I didn't have an information edge, and I got blown up. And I didn't lose all of it, but I lost half of it. And there's a lot of screenshots now of, the bottleneck bros, where the hot thing about a month ago, everybody who was trading, like, what's the 8th derivative photonics company that like, oh, somebody took a satellite image of their janitor at NVIDIA's office, therefore I'm going to YOLO this or whatever. There are people who went from like 500K to 20 million and are back down to like 5 million now because the thing worked for a while, but they didn't know when to ring the bell at the top and when to sell. And the trades started working against them, and they went on tilt and kept trading and lost the money. And whether it's SPACs, like AI, infrastructure, bottlenecks, prediction markets, there's a lot of people will have an edge in one thing for a window of time. And I actually think if you do have a legit edge where you've made 5 or 10 trades that work, and you have an objective thing you can point to that worked, I think it's okay to double down on that. It might be controversial advice, but if you have an edge, make money from it. But the hardest thing is when your edge starts going away, but you're used to making money, you think you can just keep making money doing other thing that you don't have that edge in. And that's what blew me up. And that's what I've seen happen with like 3 different market cycles across different asset classes now. It's making money is addicting. And when the thing stops working, you're like a crack addict who's looking for the next high.
That exactly describes the state of the young person's economy today.
Totally.
I think everyone's looking for the thing that will allow them to retire by 30.
Yep.
And they're willing to risk it all to do it. But then if they look at any other potential path forward, they say, okay, that's not going to work. That's going to take too long. The doomer headlines are right.
Yeah.
And then it's sort of, which path, Western man idea.
Well, there's also like, if you go for one of those high risk moves, call it gambles, and it doesn't work, 2 years down the road, the person who didn't go for that probably just got a 70K pay raise. And then you didn't because of the amount of time and mental energy you put toward trading or whatever your side thing is that didn't work. It hindered your ability to do the thing that compounds on the career path. So then you're like, okay, well now I really need to make a bigger bet to catch back up to that. So this is a thing that I think gets overlooked a lot in the personal finance, permanent underclass gambling discourse is the people who were on the same path as you 5 years ago, the longer you stick down the more degenerate thing, if you don't get your big win, you fall further and further behind the other version of you that would have done the normal boring thing where your income goes from 50 to 100 to 150 to 250. Well, now you haven't moved up fast enough. So you feel like, oh my God, I have to make up for the lost time and make a bigger bet. Like that's how the doom spiral hits, is you start comparing yourself against other people who could have been you if you hadn't done this risk and thinking to take on bigger risk instead of course. It's so much easier to course correct early, work a little bit harder and catch up. But the further you get down the wrong path, the more you feel like you have to, like, you're comparing yourself to that base rate and you're trying to catch back up to it.
It is so hard to get out of that. Jack, we have covered a bunch of different themes that have showed up in your book. And I will say, I read your book. It took me like 2 days to read, flew through it because I've also been reading your newsletter for who knows how years and years. And it reads exactly like your newsletter, but just more in depth.
That's proof that it wasn't AI. Claude didn't write this thing. Ghostwriter didn't. You'd be shocked at how much of the book industry isn't written by the people whose names on the front. But yeah.
Well, this one is definitely you. I super recommend it to everyone listening. And also, I've already gifted it to a bunch of my friends.
Let's go.
I think it reminds me a lot of the book, The Defining Decade, which I read shortly after I graduated college. And I thought it was a great book.
Yep.
It's very generalized, though. That book was written for, let's say, everyone.
Yep.
This is specifically, I think, for young, ambitious men who live in big cities.
It's funny. I've hesitated to call it a memoir because I'm like, can a 29-year-old write a memoir? I think the best way to put it is it's a memoir for young guys who are stuck between desiring adventure and achievement, and how do you navigate that in that early part of life. But yeah, it's not a book for everybody, but I do think it is the right book for a certain group of people.
I will say, fortunately for you and I, the audience demographics, according to YouTube, on this show is 90% male.
Great.
So
I love dudes.
We're in great
Those
company.
are like the best.
Yeah, we're in great company. And also, you should totally own calling it a memoir, because this is little known old lore from my own early days. I published a travel memoir, which was a collection of my travel essays from living in Hong Kong. And I called it a memoir, and I think I was 23, which was egregious to write a memoir at 23. So you at least have some life under you at 29.
I'm unk. I'm washed.
Yeah, exactly. Jack, I super appreciate your time today. Everyone should go buy your book and come back on the show anytime.
I'm down. Thanks, Phil.